right, Scott, thanks for joining us and talking about, just investing 102. I know we did 101. I really want to focus on asset allocation. And let's just start by having you define what it is from your purview.
Yeah, so the best way to start is kind of at the higher level. There are a few major asset classes that we consider at the high level. You've got equities, which are typically stocks. You can purchase equity stocks, equity mutual funds, equity ETFs, and so a stock represents the capital of a company. So you're actually purchasing ownership of the company. The next major asset class is fixed income or bonds. So you can purchase an individual bond or bond ETFs or mutual funds. The bond really just represents the debt of that company. So you're unlike an equity where you're buying ownership of the company. With debt, you're actually buying the debt. They're going to pay you an interest rate over time. And then hopefully by the end, if you've chosen your company well, they're going to pay you back 100% of what you offered them, what you gave them to purchase the bond. They'll take what you've given them. They're going to use that for an investment, and they're going to pay you back over time. So equities and bonds are probably the two primary. The next one would be cash or cash equivalents. That could be actually cash in the bank. It could be a money market fund that trades like cash, which is very, very stable. It could be a CD. So cash and equivalents kind of fall in that bucket. They're ultra safe investments. Maybe you could even put 3-month T-bills because the 3-month T-bill is considered one of the safest investments in the world. So that's your cash and equivalents. And then that fourth category is kind of your really different category. That's your alternative investments. That can include liquid or illiquid investments, and those have a very low correlation, meaning they don't move in the same direction as equities or fixed income.
Right.
Some categories inside of alternatives could move a little bit like fixed income or a little bit like equities, but they still tend to move in different directions. And when you combine all four of those asset classes, that gives you an asset allocated portfolio.
Right. So what I want to kind of just set the table with here, and then I want to talk through, when you adjust an asset allocation. Right now, we're in the midst of this Ukrainian-Russian crisis. I think it's week 4 or so in it. Market's down double digits. And part of the reason I wanted to have this conversation now is, candidly, neither one of us are really worried because we've set the asset allocation for the clients that we have before this happened. Like, you don't set an asset allocation now unless somebody comes to you fresh and you talk through it. So take me through from what, when you're setting up an asset allocation with someone, what are you really trying to achieve? Like, what's the whole point of doing it to begin with?
Yeah, and this really gets into exactly what you were talking about of being rational. Once things are calm, you sit down and you say, okay, as an investor, what's my time horizon? How much time do I have to invest? What's my liquidity need? Do I have anything specific that I need to spend money on, or can I let this grow and accumulate? And then the third thing is, how much risk am I comfortable taking on? And that varies, across every single investor. Some people may be 25 years old, and though they have tons of time on their side, by nature, they're just not very risky people. So their risk profile might look very different from another 25-year-old person who's got plenty of time on their side, and they care less about risk. And they want to, let their money grow as fast and aggressive as possible. So we have to figure out what that risk tolerance is. So you do that when things are calm. You can go through some questions and figure out, okay, what's the point where I can't really sleep at night after my portfolio has lost X amount? The way I like to approach it with clients is, okay, if we put your money in the market and then a year from now I come back to you and I say the market is up X amount, what do you want your portfolio to be up? But by the same token, before you answer that, if I come back to a year from now and I say the market is down X amount, what do you want your portfolio to be down in relation to that? But here's the catch. It has to be the same on the up and the downside. If you're willing to accept up 10%, you got to be willing to accept down 10%. And those don't always work out exactly like that. But the key is clients need to find what measure of risk they're comfortable with so that they can sleep at night and not worry about it. So you do that on the front end when things are calm, so that when we get to periods like this, hey, we set your risk tolerance back then. Unless something has changed in your life where maybe you've lost a job, you've gone through a divorce, or some other, extra extraordinary event, you're really just worried about my original risk tolerance is still intact. I'm going to stick to my plan, because when markets are doing things like this, where they're switching not just daily, but intraday based upon the news going on in Ukraine or what have you, that's not the time to be making major investment decisions. That's the time to stick to your plan and realize that you set it up for a reason. And unless something else has changed in your personal life, that plan is probably still solid.
Yeah. I feel like I remember someone saying this to me early in my career, that we have the only product that when it goes on sale, no one wants to buy it.
Exactly.
They like run for the hills, which makes no sense, but I get it. So in doing that and trying to set the asset allocation, I get a couple pieces of pushback. Primary being, how can I tell you how comfortable I am with it going down when I've never experienced it? And a lot of people are putting more and more money in, and it's growing. And you could take someone that maybe started investing in 2009 and their money's doubled, and they've been putting money in. Say it started with 100,000 and now it's 250. And so losing 10% on 250 feels way different than losing 10% on 100,000. So how do we take people through really kind of diagnosing what they can stomach if they've never had to go through it before?
Yeah, and that's where I think the time horizon comes into play. How much time do they have on their side? Because that tends to guide me first. If you're 25 years old, the likelihood is that you're going to be investing for the next 40 years. We've never, ever had a period in equity markets where we've lost money over 40 years. It's never happened. However, your chances of going through several bear markets over that 40 years is pretty high, at least three probably, because they tend to happen every 10 to 12 years. So the reality is that you've got to set that expectation up front, and then you've got to figure out, okay, if the client has never ever been through a bear market, maybe they're just getting started, they're 25, and they need to understand, what does that look like. I think it helps. In our industry, we tend to talk about percentages. I think for the average investor, in terms of dollars, is probably the place to start. So again, you gave me 10,000. Now your portfolio is worth 5,000. You've lost half. And the reason why I say half is because in 2008, from peak to trough, the S&P was down 56%. So if I tell you that you gave me your 10,000 yesterday and today it's worth half, that's a whole different discussion than saying, oh, you were down 50%. It just feels different for an investor. So I think that if you can start with that 50%, i.e. being the worst case scenario, 2008 was basically a 3 standard deviation event. That's an easy way to understand, okay, that's what risk really is.
Right.
And I'm okay with that, or I'm not okay with that. I really want to half that risk. Well, if we're going to half that risk, we've also got to dial down your equity exposure, because that's your riskiest component in your portfolio.
So I know there's tons of magazines out there, Kiplinger's, Barron's, and whatnot, that give you different ideas on just a general baseline on where should I start to understand how much is too much equity or how little. I think Vanguard has, take your age and subtract it from 100, and that's how much you should have in equities. And so it's just a kind of a easy sliding scale. So there's different ways of looking at it. But I want to kind of get back to your idea of expectations and timeline for a goal. Because I think you can have buckets too. Like you can have that 25-year-old, and he can have a retirement plan that he can't touch. He can't touch without getting taxed until he's 59. So there is a kind of embedded time frame for that. And then they could, in the same token, say, look, my spouse and I are looking to also buy a house. How do we invest that? So you have different time frames, different risk tolerances, and it can get confusing. But take me through something that I thought was really good, the idea of this absolute return. The idea of, what are we really shooting for? Are we shooting to beat an index? How do I measure success when I'm investing? Because I think that's a better place to start when I talk about asset allocation, as opposed to, I'm going to try to beat an index by having a certain, stock and bond mix.
Yeah, so I have to quote one of my favorite generals, but also one of my favorite characters in history, General Patton, who said, America loves a winner. Yeah. And that's what we want. We always want to win. We want our favorite team to win. We want our portfolio to be the best. And so, unfortunately, we end up comparing our results to everybody else. Mm-hmm. So here's a great example. Let's suppose you've got a really close friend, and that friend gives you $50,000 at the end of the year for Christmas. just to give it to you.
I want that friend.
Just because he's a benevolent. Yeah, you would think, gosh, that's a great friend, right?
You can be my
he
friend.
Just give me $50,000. And so today, you're $50,000 richer than you were yesterday before he gave that gift to you. Now, let's suppose he does that for 10 years. He gives you $50,000 a year for 10 years. You're at $500,000. You just got $500,000 for doing nothing. Now, at that moment, you're probably ecstatic. I mean, this is the greatest thing that's ever happened to you. You're loving life. But let's suppose at that last event, he also tells you, or you find out, that another friend that you two have in common, he gave twice as much. He gave $100,000 a year. So now at the end of 10 years, that guy, that friend of yours, has $1 million. You're probably ticked off, right? You're like, what the heck did he do to deserve that? Yet just a few moments earlier, you were super pleased that you had $500,000 for doing nothing. That's the problem that we're into now. We're constantly comparing ourselves to other people. So when it comes to returns in your portfolio, there's absolute versus relative. Your absolute return is what you need to get to your goal. Your relative return is what your return looks like compared to some arbitrary index or some other person that you're measuring your portfolio against. Maybe it's your best friend you've got a rivalry with, and you always want to do better than them. You really should be focused on your absolute return. Because if you've done your financial plan and your advisor has said, look, you need to get X amount, let's say it's 8%. You need to get 8% a year, give or take, on average, to get to your goal. What do you care if your friend got 14%? That's their issue. That's what their portfolio is giving you. You just need 8%. So as long as you stay on track, you're going to get to your goal, unless your goal changes along the way, which is possible. But as long as you stay focused on that absolute return, you should be 100% pleased. The problem in our industry, has done this to investors, is constantly getting them to focus on an index or a blend of indexes. So here's the problem. An index never has to keep cash. It's always invested 100%. You may have liquidity needs where you've got to keep some cash in your portfolio. The index doesn't have a life expectancy. It goes on in perpetuity. But you have to balance your risk tolerance with the fact that you've got a life expectancy, and at some point you've got to draw money off of your investments to live once you've retired. The index doesn't have to compensate for distributions for spending needs, but your portfolio does. And there are other things in there too where really it shows the index really isn't that relevant to your portfolio. Mm-hmm. Not to mention the fact that most people don't have 500 stocks in their portfolio and that's it. That's what the S&P is. That's typically not what your portfolio is going to look like. And so, if we took an investor who put $400 a month and invested over that time, what would let's suppose it's 40 years, like we used in our example of a 25-year-old. At the end of that time period, the end of 40 years, that $400 a month is now worth $787,000. That's pretty close to $1 million. So that if a financial advisor told you that's what you needed to get to your goal, you ought to be super pleased. Now, what most people don't realize is that portfolio only earns 6% a year on average. 6%. That's almost half what the S&P typically averages. So again, on the forefront, you got to 787,000. You're probably super pleased, but then you learn that the S&P was up almost twice that. Now you're mad because you're constantly comparing to something else that really has no relevance to your portfolio whatsoever.
Right. No, I like it. And I also like the fact that, even when we say the index, you've got the Dow Jones index, you've got S&P 500, you've got NASDAQ, you've got different indexes for different pieces of the quote unquote market. And it's a little hard to, you choose the one that's up the most, so sometimes you could say like, I chose the S&P index and I should have chosen a different one. So it doesn't always work. I love the idea of having that absolute return and knowing that's where you want to go. And again, it can shift, but knowing that's kind of where it is. So, I want to ask one more question and I'm going to wrap it up. How do we help people not get super comparative on things and not get worried when the market's down and not feel bad, and just kind of stay on point with what that absolute return is?
Yeah, the best way I can do that is to give you an example of where, getting greedy or always looking at the best performing index can get you into trouble. So let's take the tech bubble of 2000.
Oh, yeah.
In 95 and 96, if you were invested in a balanced portfolio, you got about a 45% return. If you had the S&P was up 69%, 95, 96. So if you're looking at your portfolio relative to the S&P, you're thinking, gosh, I could have gotten 69%. So if you stayed on track, your portfolio ends up doing really well. If you get greedy, you run to the S&P and you go 100% S&P. Now, the first few years of that, you're doing pretty good. But by the time the tech bubble hits in 2000 and ultimately ends in 2002, if you stuck to your goal, your portfolio is over $1 million. That's exactly what your financial advisor told you needed, and that's exactly how you're going to hit your goal. Your greedy guy, he went to the S&P. His portfolio is now worth $939,000. He has now missed his goal. He's going to have to continue working to get to that $1 million goal because he got greedy. He got off track and didn't stick to his plan.
Right.
So that's the best way to explain to someone the difference between absolute and relative returns. Stick to your plan. Worry about how you're doing towards your plan. If you need to adjust, you can, but don't get off to the rails and get into the relative return trap.
Right. So an advisor can kind of help you design what that absolute return is, and just practical strategies that we can use. I'll give you a simple one. Just don't check it every single day, especially when the market's going all over the map. We've got a lot of people in the midst of this right now that, my clients don't really do this, but there's a lot of people that'll look at it and get very, scared that it's not potentially not going to come back or whatever. But we just had, since COVID, like a 60-70% rally, just ran on through. So you made a lot of money. You almost kind of need a little bit of a cool off. And these cool off periods, like you were saying, over a 40-year period of time, you're going to have 3 bear markets, but you just stay consistent. And in those bear markets, you don't look and sell, because then you're selling low. You want to make sure you just you write it out. You trust in the process, like you were saying with this whole tech bubble, example, and let things kind of stay consistent and roll through. I don't want to talk about rebalancing now, but I want to talk about rebalancing as a strategy to kind of formulaically take the emotion out of it, to buy low and sell high. Do you have any specific things like that, like don't look every day, that people could potentially do?
Yeah. What you want to do when things are normal and you're setting your plan up, look for stable returns. Don't look for the highest return. Your portfolio is going to do well. If you're doing asset allocation, something's going to be doing well at the same time something won't be. So you want an asset allocation strategy that generally has stable returns. Also, strive for a reasonable return. Don't reach for some return that's really not achievable year over year. Strive for a reasonable return that's going to get you to your goal. And don't compare yourself to some arbitrary index. If you've got a component of your portfolio, let's say it's international, and that looks well versus the MSCI EAFE, that's something reasonable to compare a component of your portfolio. But don't take your overall portfolio and compare it to the S&P when you're really not invested in the S&P.
Right.
So those 3 things, I think, help you stick to your plan, formulate it correctly, stick to it, and don't get off into the weeds. To your point, don't sit there and watch it every day and listen to the news and get all upset about how your portfolio is doing. You got to remember the old strategy, which it's been made fun of in movies. I think Up Close and Personal, they kind of made fun of it. If it bleeds, it leads. Mm-hmm. And that's what the news does. The news wants you watching something, and they're going to be grandiose about it, and they're going to blow it out of proportion. And the next thing you know, you're emotional and you're not thinking rationally. So stick to your plan, and you're going to be probably okay.
Super. Well, Scott, I appreciate it. It was a really good overview, and look forward to doing Investing 103 with you soon.
Yeah, looking forward to it.
Take care.
Thank you for listening to the Thought and Action Podcast. If you enjoyed this episode, don't forget to follow the podcast and leave a review. For more information on what's going on in the world of wealth, make sure to follow Family Fortune Financial on your favorite social media platforms. I look forward to you joining again soon.